Understanding volatility for options traders. That's such an important topic because the volatility is priced in the options prices, and therefore we may be buying overpriced options, we may be selling underpriced options, which would put us at a tremendous disadvantage. But let's understand volatility first, because volatility is a generic word that often is being used as a generic word. And as options traders, we need to be a bit more precise than that. Again, volatility is critical because, while I'm going to define it with more detail, volatility is priced in the price of the option, what we call the options premium. So if you have traded options before, maybe in an early stage where you were not fully understanding how to select the strike, how to select the expiration date, you may have found yourself in a situation where you bought a call, the stock started moving in your direction, but then you look at your P&L and it's negative and you cannot believe it. Most traders focus entirely on the price, direction and time, but underneath the surface there is that hidden engine, which in this case is the options premium, which incorporates the volatility expectation for the future. And therefore you may have purchased a very expensive option which is deflating against you, just like the concept of inflation applied to any product that we purchase in our personal life. The same applies to options trading as well. So let's get deeper into understanding volatility, and the first thing that we need to define is the fact that there are two types of volatility: historical volatility or historic volatility or statistical volatility, and then we have implied volatility. Historical volatility is looking backward, it's your mirror, right? Looking backwards to see what a stock is capable of doing from a volatility point of view, from a speed of movement point of view. Certain stocks are very volatile and very violent, whereas other stocks are on the boring side and they don't move much, or anywhere in between. So historic volatility or historical volatility allow us to understand the nature of those stocks or those financial products that we trade. So we know if a market has the potential to move at a certain speed or not. Of course, the fact that in the past a market has moved at a specific speed doesn't mean there is any sort of a guarantee into the future to move at that same speed or not to go faster or slower. But it's a good reference, especially when we trade liquid assets. While market conditions change from time to time, those liquid assets will typically tend to behave the way they do because they are traded by those very large players, those very large institutional traders, and the amount of buying and selling that is happening in those assets sets their volatility levels, which tend to be similar and may change from time to time, but they tend to be similar. So understanding the historical volatility is important. Having said that, again, we trade into the future, we don't trade into the past. And implied volatility is the real important number here. Implied volatility is the volatility that is priced in the premium we pay when we buy a call or when we buy a put. So let's say you buy a call and it's $3. So within those $3, a portion of that amount of money is basically reflecting the expected speed of movement into the future. We call it implied volatility because it is implied out of the price of the options contract itself. A clear example could be to think about an earnings report where a company is about to report earnings and therefore everybody expects the stock is going to gap. Everybody expects good earnings reports or bad earnings reports, and there is a great expectation for a potential jump in price when earnings reports become public. In such case, you could imagine options becoming very expensive because that expected move that has not happened yet is already priced in. Whereas the opposite is true. Maybe after earnings, the stock really did nothing at all and all the expectation evaporate and everybody is going to be, okay, we expected this to happen. Not much is going to happen. Now it's obvious because the report is public. So everything cools down and no one wants to pay $3 for that call anymore. They were okay to pay $3 if they expected, let's say, a 10% jump, but now that the expected jump is nothing, maybe they want to pay 1.2 only, and the options deflate, reflecting that the implied volatility in them is so much less. This is critical, and before I keep going, I want to be a bit visual here. So I'm looking at Netflix here, for example, and I am going to add an indicator. You can go to indicator settings and you can scroll down. There is an indicator which is ℎV/IV for historical volatility / implied volatility, and I'm going to activate it. And at the moment I have set up the indicator to only show me the implied volatility. You could come in here and you could activate implied and historic, and then you have two lines, orange and blue. I'll do one at a time. So we'll start with implied. And when I look at implied, you can see that there are times options become expensive, and then they become cheaper, and then expensive, and then cheaper, and then very expensive, and then very fast, cheaper. Look at what just happened up there. It was the earnings date. Okay, there was a lot of expectation building up into earnings, then earnings took place. Everybody now knows the result. The stock actually did gap from here to here, but now everybody knows. So now the expectation for the following days is going to be just a normal expectation till something happens in the market, or we are approaching the next earnings report 3 months later or something like that. And you can see options inflated and deflated, and it's a cycle. Actually, the implied volatility, the volatility priced in the options, does very much present consistently a mean reversion type of behavior. So going from expensive to cheap and anywhere in between, and keep going through those cycles. Now, if instead of implied volatility, I was to look at historical volatility, which is the orange line, so we can see how it is not so much up and down. Definitely when stock accelerate in movement and there is a huge increase in speed, so historical volatility shows that. Okay. And then if it's quieter, it shows a bit more quieter. And right now the stock has been doing nothing for a while, really going sideways, and the volatility of the stock is going down by a large amount. Okay. So now something that could be interesting, which I'll do in a moment in a way that is a bit more sophisticated, is to compare the implied and the historical volatility, and notice that there are times where the blue line is below the orange line, and there are times where the blue line is above the orange line. So in other words, right before earnings, we can see that the expectation was that the stock would move at a rate of 50. 50 in terms of volatility is a percentage, and it's an annualized percentage of expected volatility. In other words, the options were priced at a level where a 50% move, either up or down, was priced in the price of the calls and the puts. So 50%, whereas the speed of movement of that stock at that moment in time, okay, was 15%, as you can see on the right side of the chart, 15%. So in other words, options were priced at a level of 50, whereas the current speed of the stock was moving at a rate that if it keeps going like that, 1 year later, it would be 15% either above or below. So in other words, you could call these overpriced options. The options prices were pricing in a move which is larger than what the stock has been proven that is capable of doing based on its own speed of movement. So I'm looking at the rear mirror orange line. The stock is moving at a rate of 15%, and I am looking at through the windshield, and we are looking at 50% movements into the future. Now, it doesn't mean people are right. Actually, people are wrong all the time. So you could certainly sell expensive options when they are that expensive. And the opposite is true. At this moment in time, maybe options are very cheap because they are way below the speed of movement at which the stock can show it's capable of. And therefore, you will be buying cheap options, which is a good beginning of a story. Having said that, in a moment, I will present a better way on how to look at implied volatility and understanding if your options that you're about to trade today are cheap or expensive. But again, it always implies this comparison between historical volatility and implied. And again, both terms use the word volatility in them, but it's a totally different animal, because one is realized volatility, something that truly happened but is done, where the other one is the expectation for the future, which is what we trade. So we really need to understand that better. So historical volatility looks in the rear view mirror. It's a measure of how much the price of an underlying has actually fluctuated over a specific past period. The math is a standard deviation of price returns over a defined look-back window. So typically it's an average. So you look at, let's say, the last 30 days and how fast the price have been moving, how much return on investment in a daily basis has happened, and then you average it and then you project it for a year. And that's what it means. So again, a historical volatility of 20 means that at the current speed of movement, given the last 30 days of price movement, the stock would be either up or down 20% in 1 year. It has potential to go there if it keeps moving at that speed. That's what it means. Whereas implied volatility, it's looking through the windshield. So implied volatility is the market consensus forecast for future price magnitude. Basically, people are buying and selling calls, people are buying and selling puts, and they place bids and offers for such trades. Depending on their expectation for how much a market is going to move, they may be happy to pay more or sell it for less, or vice versa, right? So let's say you expect the market to move a lot, so maybe you don't mind to buy an expensive call because you do expect it to move a lot, so you have a good reward to risk ratio. Even if you pay a lot for the call, because you expect it to move a lot, you're going to have a profit which is significantly superior. So you may be okay with that, or maybe not. Maybe the opposite is true and you expect the market to do very little, so you would only buy calls or puts for very little. Therefore, your expectation, and in this case the consensus opinion of the market, all the buyers and the sellers of calls and puts overall across the world, they basically present their view, they express their view of the market by placing those bids, those bid prices and those ask prices when they place an order. So it represents a one standard deviation expected move. So that's they expect the market to be either up or down by a certain amount in 68% of the cases. So for example, if implied volatility is 22%, it means that you expect the underlying asset to be either up or down by 22% in 1 year, and that would be in 68% of the cases. So you are fairly confident that the trading range would be around 22% either up or down. Volatility expectations dictate options premiums. Okay, the more the expectation, the more expensive the options, calls and puts. The less the expectation, you expect a boring market, then the cheaper the options, both calls and puts. Okay, one way to understand more the impact of options prices, and more specifically in this case volatility, is to look at what we call the options Greeks, with which the term options Greeks often feels intimidating, and so many people will be very much turned off by it. To be honest, it doesn't need to be like that. Indirectly, we already learned a bit about some of the Greeks, delta and theta specifically, in prior video lessons. Let's talk about Vega now, but overall, there are 5 main Greeks: delta, Vega, theta, gamma, and rho. While we'll cover them little by little, just think about all of them as meters in a car dashboard. So you're driving your car, and next thing you need to know the speed of the car. You're driving your car, next thing you need to know more about the RPM, right? How many revolutions per minute that engine is rotating at. Maybe you are looking at how much fuel you have left in the tank of the car. Maybe you are looking at how hot or cold the engine is, or maybe the temperature of the oil instead of the temperature of the water. So all those meters are normally available in your car dashboard, and when you drive, you are just reading what's the value, what's your speed. Okay, you're driving at 110 kilometers an hour. Great, now I know. So you just need to know the speed. It doesn't mean that these particular values or Greeks are gonna make your life that complicated, okay? You just need to know what they are and what they mean. D for delta. In a prior video lesson, I was suggesting to remember D for direction. So delta measures the directional risk. If delta is 20 and the stock goes up, you make 20. If it goes down, you lose 20. So know the speed of profit or the speed of loss. Theta is the time decay. So T for time, it's how much fuel is left in your car, right? So if you got 30 days to expiration, it's not the same as if you got 2 days to expiration. We know options decay, and they decay faster as they approach expiration. So now you know how much decay you have per day. If theta shows you 20 cents, you know that even if the stock stays the same, even if the market goes your way, even if the market goes against you, no matter what, you're losing 20 cents a day just because time passes. Vega is your engine temperature. Okay, it measures how much value is made or lost every time implied volatility goes up or down, in this case by 1%. So example, let's say you are in a trade. You bought a call on Netflix. Okay, I'm gonna simplify this a little bit by leaving only the blue line, implied volatility. And let's say when you bought the call on Netflix, okay, maybe you bought a call here at that particular time where implied volatility was 34. So you bought a call on Netflix. Let's say you paid $5 for the call, and the call has a vega of 1.5. So you have a vega of 1.5. Okay, I'm just improvising that value, okay? You have a vega of 1.5. By the way, you can see that in the option chain actually. Okay, so let's say you bought an option that expires. Oh, this is not Netflix. Let me change it. Netflix. Here we go. So here's Netflix. So let's say you bought an option that expires in 45 days. And so we look at the vega, and you can see the vega here. So the vega is 0.12. Okay, so let's use 0.12. So I use a number instead of making it up, 0.1290. Okay, so this is your vega. And so this is your vega. And when you trade in Netflix, you purchased your call when the implied volatility was 34.41. Okay, so 34.41. Okay, right there. That was the implied volatility. And let's say price went your way or against you. And in this case, price went down. So let's pretend it was a put. So you were making a profit. Congratulations. But no matter if you were making a profit or a loss, the options inflated. So let's say you exited the trade at this point, which is 47.38 implied volatility. Okay. So in other words, you collected a difference of 12.97. So the difference between the implied volatility when you entered and you exited was 12.97. Options have increased by 12.97 implied volatility, which with a vega of 12.97, which with a vega of 0.1290, which is the vega that we saw before, that means that you would have made 1.67 times 100, so you would have made extra $167 per contract. So let's say you paid 5, so even if the stock went against you, you made 1.67. So now your option, if the stock stayed the same, your option is going to be 5 plus 1.67, so is 6.67. So you can now sell that option for a profit, even though maybe the stock stayed the same. It's just that the implied volatility went up. So Vega allows you to calculate how much you're going to profit or lose. Now, of course, just like you don't know for sure what the market is going to do, you have, of course, a trading strategy that allows you to decide to go long or short, but you don't know for sure what the market is going to do. So same with volatility. We know volatility tend to revert back to the mean, but we don't know exactly when. So typically the best advantage would be to buy when volatility is low, buy options, or to sell options when volatility is high, because you have this normal tendency of reverting back to the mean. So if you sell options when volatility is high, you sell them when they are inflated and you benefit from their deflation as volatility goes back to the mean. Or you buy options when they are deflated, so you benefit from their inflation when volatility goes back to the mean. So you don't know when that's going to happen precisely, you don't know how much is going to move, and the vega you get is whatever you get. But again, what would be a problem is to buy options when they are inflated, because then if they deflate against you, you may be right on the move and you lose as a consequence of volatility deflating. Plus, on top of the deflation that has to do with the expected future move, you have the time decay, which I'm not discussing today, but that's happening all the time because time passes all the time and always going forward, right? So it doesn't go backward. So we have the time decay hurting the trade when you buy a call or you buy a put. And when you buy the call or put, if you bought it deflated, that's beautiful because it will tend to inflate back when volatility reverses back to the mean. But if you bought it when it was inflated, now you got the time decay eroding the options price, and then you got the mean reversion of the options prices happening, so you are losing because of deflation on the implied volatility plus the time decay. So you better have the stock move at the speed of the light in your favor, because then the only delta would make money for you, theta is hurting you, and vega too. So in other words, it's critical that when we trade options, we are aware of the current level of inflation of our options. Are we buying deflated cheap options, or are we buying inflated expensive options, which would basically get us to start the trade in the back foot? We don't want to do that. We know the market's transition from calm to chaos all the time, which is why you have this natural, consistent mean reversion effect, okay? And therefore, we want to look at charts such as implied volatility to understand where we are in the cycle. And an even better to understand where we are in the cycle, to be honest, is not to use that indicator. Is to actually look at options statistics. You can click on the option statistic tab. And here you have beautiful, really interesting volatility level comparison here, where on top you have your implied volatility, below you have your historical volatility, and then it's telling you what is the 52-week low for implied volatility and what is the 52-week high for implied volatility. And same for historical volatility, what is the 52-week low for historical volatility and what is the 52-week high for historical volatility. Even though I'm noticing here a typo on the platform actually, where it says IV and it should be HV. So take a look. So we are looking at a low of historical volatility of 15. Okay, we are looking at a high of 60, and the current level of historical volatility, this is for Netflix, is 21%. So in other words, during the last year, this stock has shown to be capable of going as slow as 15% a year to as fast as 60% a year. This is the real speed that the stock did show in the real world. Now, that was in the past, but it's a good reference to know how fast it can go and how slow it can be. Now, with that said, the current level of historical volatility is 21.22% is the current level of historical volatility. So the stock, I'm not looking at options yet, it's all historical, is the stock. So the stock is moving a little faster than 15. It is in the 16% historic volatility percentile at this moment in time. In other words, it's moving slow, not that slow, but definitely not moving fast at the moment. Okay? And again, if you look at the chart, so we can see how Netflix is not doing too much, but instead of not doing too much, which is totally subjective, now we can have a quantitative approach to understanding how slow or how fast, which is 16%. Now, when we look at the implied volatility, okay, we can see that the low is 24.79, the high is 76.44 for the year. And notice that the current level of implied volatility is actually the low. We are talking about 0% percentile. So we are dealing with levels of volatility which are the lowest they have been in the year. Having said that, while the volatility is very low, the implied volatility, now we are talking about the options prices, okay? What are they pricing in? Right? How much volatility is priced in the options prices, the options premiums? So we are looking at the lowest values for the year, but notice that those lowest values for the year, they expect the stock to go faster than 21, which is the current level, okay? So yeah, implied volatility is very low, but in a way, is not that low compared to, let's say we look at UPS, if I look at UPS and I look at option statistics, so let's take a look. So we have the stock moving at a rate of 27. This is the speed of the stock. Historical volatility is moving at a rate of 27, while the low for the year is 14, the high for the year is 54. So we are talking about a 24% percentile. So in other words, the stock is doing something average. It's doing something normal. That's the speed of the stock. Let's take a look at the chart. Okay, so the stock is moving at a speed level which is normal. It's not moving like crazy like that or crazy like this. It's doing something normal from a speed point of view. But again, instead of subjective words such as normal, 54% percentile, that is more quantitative and more precise. So that's what the stock is doing. Now, while this is the case, the implied volatility at the moment priced in the options is 25%. 25% is definitely less than 54. So options prices are pricing a move which is less than the speed at which the stock is moving now. That smells cheap to me. But on top of that, the implied volatility range during the year has been going from 20 to 64, which is a 13 percentile. So in other words, without looking at the speed at which the stock is moving, which is historical volatility, let's forget about historical volatility for a moment, we can see that options levels with an IV located at the 13% percentile, that's pretty low. But on top of that, what I like about UPS compared to Netflix is that 25 is less than 54. So you have two ways to confirm that implied volatilities are low, therefore options are cheap, and therefore if you had a specific trade plan, maybe you want to buy a put, it's probably not an expensive put given what we said, so you would just go into your option chain and find the right strike, find the right expiration as we have discussed in prior video lessons. Very good. Hopefully all of this is making sense. It is actually critical and hopefully it's clicking in. Now, having said that, I am looking at implied volatility as one number, but the fact is that each strike and each expiration date got their own volatilities. Okay, and that's how we end up with this volatility smile, which is how we call this graph. Take a look. If I look at, this is Netflix, okay, and I pick 45 days, this is okay. Notice how I have my implied volatility value here. 47, 46, 46, 45, 45, 44. It goes to 43, 42, okay? And then it keeps changing, okay? Now, notice that each strike has a different level of volatility, okay? Different level of volatility, okay? So, in the world of options, each strike got a different level of volatility, and on top of that, we have something called the volatility skew. Because typically puts are more expensive than calls. So as you move away from the at the money strike ATM, you go out of the money for the calls. The calls are a little bit more expensive every time given their implied volatility. They are cheaper because they are deeper out of the money, but the amount of extrinsic value you pay per strike is slightly more as you go up. Why? Because people tend to be bullish, so they are okay to pay a bit more if you expect the stock will go higher. So you have a little bit of that effect, but it's very mild, okay? Whereas with the puts, people are fearful and they are willing to pay a lot more for the out of the money puts as you go down the option chain into lower strike price points, right? So you have this volatility is mild, but it's skewed, okay? So again, there is a lot of moving parts, and in the end, of course, when selecting your calls and your puts and your expiration days when you trade, you certainly need to pay attention to this as well. But again, the key is to have a starting point where you are not buying expensive puts or not buying expensive calls, okay? When you sell, you don't want to sell cheap calls or sell cheap puts. You want them to be expensive when you sell them. You want them to be cheap when you buy them. So again, looking at those volatility levels and understand where you at in your percentiles, both like looking at implied volatility and then comparing it with historical volatility. So that would be the best way to approach it. There are obviously many ways on how to do various technical analysis for options trading, but this is like the basic of making sure your implied volatility is low compared to itself, and ideally implied volatility low compared to historical volatility. So the trap of buying expensive options is that, I think the picture says it all, right? So you buy an inflated balloon and then like you do it in front of earnings, for example, or in front of an event, and next thing you know, the event has passed, the expectation shrinks, and this is what would happen to your options price. So if this is going to happen to your options price, the only way to make money is that now the stock needs to move by the amount of premium you pay for the option and more, and this needs to happen before the option expires. So now making money becomes very difficult, and it's just because you started buying an expensive call or an expensive put. So make sure you got this under control, and you do look at the level of implied volatility before buying your options. At the end, I will also comment on what to do if volatility is not cheap and volatility is very high and you are in the middle. So what do you do then? You may be thinking about that, okay? So when options are overpriced, you sell them. That gives you an advantage. When options are underpriced, you buy them. That gives you an advantage. What if volatility is somewhere in the middle and you want to neutralize the volatility threat? Well, you would need to do what we call option spreads, which may or may not be available. So I will work from the angle that what to do if you don't have option spreads available, which this could be the subject for further lessons. It's definitely a more complex thing to do. If volatility is a threat to you because you are not in a very low situation or very high situation, then something that you could exploit is your long synthetic strategies. So you could buy a call, which is very expensive. That's bad. But you also sell a put against, which is also very expensive. So again, you neutralize the extrinsic value and the time decay you're going to suffer on the call. You neutralize it by selling the put, and then you benefit from that same time decay with just as expensive as an option. So that's where we are. Low volatility, be ready to buy calls and buy puts. High volatility, be ready to sell calls and sell puts. That's when you get the greatest benefit, because even if you're wrong, you would likely see your mean reversion effect on the prices of the options, and that's going to pay you through Vega at the rate of Vega, okay, with that meter. If you are uncertain, you can do spreads if that is available and you have been educated to do, again, subject for a future lesson maybe, or you can just go the route of doing your long synthetics. Remember, a long synthetic is a strategy where you buy a call and you sell a put at the same time. So if that call is very expensive, then you also sell a put which is very expensive. So they neutralize the time decay element. If the call is very cheap and the put is very cheap, well, you bought a very cheap call, there is very little to neutralize, but you sold a very cheap put, which neutralizes just a little bit. So the two together do neutralize each other. Let's say implied volatility is in the middle, so you don't know if they're cheap or expensive, is somewhere in between. You buy a call, which is somewhere in between when it comes to how expensive it is or cheap, and you sell a put, which is somewhere in the middle when it comes to how expensive it is or cheap, and therefore they neutralize each other. And this is how you would be able to deal with volatility, so it does not end up hurting you because you didn't do such assessment. So look forward, not backwards. Rely on implied volatility to understand market expectation. Vega will tell you what's your exposure, how fast you're going to profit if volatility moves in your favor. And respect the cycle. Markets go from underpriced to overpriced while mean reverting in the meantime. And make sure you have that risk under control, because again, buying an expensive option is going to risk you more money because you pay more premium, but on top of that, it puts you at a disadvantage because it will tend to deflate. So buy underpriced options and make sure you do your assessment when it comes to understanding their implied volatility levels.